Now let's talk about the pros of the buy and hold strategy. Well, the pros of the buy and hold strategy start with it works. Simply put, it's been proven time and time again that the buy and hold strategy can produce exponential returns over the long term. And some of the biggest names in stock market history were huge proponents of the buy and hold strategy. We all know who Warren Buffett is. Buffett is a huge proponent of it. His teacher, Ben Graham, who wrote The Intelligent Investor and Security Analysis, which if you haven't read as an investor, you probably should read both of those books. He was a big proponent of it. Peter Lynch, who managed the Fidelity Magellan Fund, he was a big proponent of buying and holding things for the long term. Jack Bogle, who created Vanguard, who was all about low cost, low turnover investing. He was all about the buy and hold. All of these individuals had this buy and hold mentality, and they all won. They all made great returns over the long term. Obviously, Buffett being the best of those and the best at it. And there's a little luck to that as well, that he was earning such huge abnormal returns for a long period of time. But buying and holding did him a lot of good. And it did all of those guys a lot of good, and it can do us good too. Now, like I said, I do want to focus on buying and holding when it comes to purchasing individual stocks. But just to look at the idea of buying and holding in general, if you just bought and held the S&P 500 index fund, over time, that has outperformed actively managed large cap funds 86% of the time. 86% of the time, you would make higher returns than the active funds that are constantly buying and selling and trying to get into new things. And that's a big deal. And that can also inform us a lot about buying and holding individual stocks, because you would expect in a similar way that if you are buying and holding individual stocks, you can do a lot better than the individuals who are trying to trade the single stocks all the time. I'm telling you, turnover is costly, and it can be costly for multiple reasons, like not receiving the income off of the investments and reinvesting those dividends. It can be costly because of transaction fees. It can be costly because of taxes. It can be costly because you didn't get the full potential of that particular stock because you got a gain and immediately sold it. Like, you can lose a lot of net returns by selling too quickly and by actively turning things over. If you are buying and holding for the long term, you can really benefit by having less taxes, by having lower transaction fees, by being able to get dividends and reinvest those dividends, and by being able to realize more of the appreciation in price of the individual stocks that you purchase. So, okay, it works, but what else about the buy and hold strategy? Well, fewer headaches. The buy and hold strategy leaves us with far fewer headaches. And the reason for that is that we don't have to worry about trying to time the market. We're not trying to jump in at the right time and jump out at the right time. If you have a buy and hold mentality, you are buying something that has long-term value, and you are holding that thing that has long-term value until it no longer has long-term value. It's that simple. You're not trying to jump in and out quickly, and that can be a big headache. Big headaches for investors who are trying to trade or who are not buying and holding and are trying to make short-term profits is, when do I buy, when do I sell? Especially when do I sell? Like, it's very difficult to sell something that has gone up in price. I have dealt with this myself. You buy an individual stock, you're holding it, you're making outstanding returns, you want to sell it because you want to realize those returns. Then it turns out you realize the returns, but you could have realized a lot more if you would have just held on to the stock, because that was a good long-term value creating stock. So this is a very real thing, and it creates headaches. It is hard to do. Nobel Prize winner William Sharpe, in his 1975 study, Likely Gains from Market Timing, finds that a market timer would have to be accurate at least 74% of the time to beat the index. That just doesn't happen. Individuals are wrong all the time. And it's very interesting that we talk about this week, because a lot of individuals tried to market time around a certain event that was going on this week, the election. People are trying to market time around that. They either want to get their money in because they think that it's going to explode upward after the election, or they want to sell because they think it's going to drop hard after the election or whatever it may be. They're trying to position themselves and time the market based on the election. And most people who try to do that are just going to lose. They're not going to beat the index. They're not going to be able to time it correctly 74% of the time. It's almost impossible. It's basically a coin flip of whether you can time it well or not. Now, what else is a pro of the buy and hold strategy? Well, it's based on cold hard fact. The buy and hold strategy is based on what we call fundamental analysis. And fundamental analysis is looking at firms' financial statements, looking at just different financial information that the firms disclose to the public that you can make decisions based on. Now, it's a very objective thing, but there is some subjectivity into it because having to discount future cash flows and determine what future cash flows are going to be requires a bit of subjectivity and guesswork. Then also trying to determine what future price to earnings ratios are going to be also requires a bit of guesswork. But for the most part, it is based on solid financial data, and you can determine value based on solid financial data without having to do too much of that guesswork that I was just talking about. So we're basing our decisions on cold hard fact, not on what we think a chart's going to do in the short run, or oh, they're going to have a breakout, or the golden cross, or if you've never heard of these things, go look them up. It's a science, I guess. Technical analysis is wild. It's hard to keep up with, and it doesn't work by itself in broad application. It can be useful when held along with fundamental analysis, but I digress. Not something I want to focus on over the course of this video. Then lastly, a pro of the buy and hold strategy, as I've alluded to previously, it is great for taxes. If you buy and hold over the long term, you're going to incur far fewer taxes, first of all. Second of all, when you do incur taxes, it's going to be at the capital gains rate, not at your individual income tax rate. And this is huge because I think a lot of times individuals are only thinking about gross returns. They're only thinking about, oh, I made 15%. Oh, I made 13%. I made 8%. I made however many percent somebody makes. But they're not thinking about the fees that went along with that. They're not thinking about the tax implications that went along with that. They're not talking about any of these things that are going to decrease the returns they actually see come into their account. So many individuals say that they see good gross returns. They see good returns that are reported to them by an advisor or by a mutual fund company or something like that. And then they look and they go, well, my account hasn't moved much. Well, I wonder why. Because you're paying fees, you're paying taxes, and taxes are a killer if you don't keep them under control. So the buy and hold strategy can be great for taxes if you do it correctly over the long term. You will pay far fewer taxes than those who are churning or those who have high turnover as far as their portfolio of stocks goes.